Hello, everyone, and welcome to another full spectrum interview where we are questioning specialized experts about current events and the things you need to know. Today's guest is David Morgan. David is the operator of silverinvestor.com and produces the now famous Morgan Report. He's appeared on CNBC, Fox Business, and BNN in Canada. He has been interviewed by the Wall Street Journal, Futures Magazine, and the Gold Report. David consults for some of the world's largest hedge funds, high net worth investors, mining companies, depositories, and bullion dealers. And he is also the author of Get the Skinny on Silver, which is a Morgan James publishing in the year of '09, and is a featured speaker at investment conferences in North America, Europe, and Asia. And he is here with us today to give us an inside look on what is really impacting the silver market. David, how are you today?
I'm doing quite well, thank you.
Good. Now, I know that you hold degrees in finance and economics, and that's why the large hedge funds reach out to you for consultation. For our listeners' benefit, can you tell us about the transcendental nature of sound money and its effects? And by sound money, I'm referring to precious metals, both gold and silver.
Yeah, there's been books and treatises and all kinds of things written, but to be succinct, the long-term view of the history of money is basically either sound money or not sound money. If you go back into history, and this is a broad brush, so it's not going to be entirely accurate, but it's going to give the correct flavor. When you have a stable, commodity-backed bimetallic standard, gold and silver, you have the best price stability. And when you go off of that, and usually you go off of it from a bimetallic to a monometallic, meaning like a gold-only standard, that morphs into a gold cover type of standard, and eventually the gold is usurped by the paper system. So basically you go from sound money to unsound money, you have a collapse, and you go back to sound money. So sound money, unsound money, financial problems, back to sound money, go off sound money, more problems, and back. And that's a very cursory, broad brush view, but that's basically what happens. If you look at the price structure of under a sound money system, you'll find that prices remain stable for decade after decade after decade. A loaf of bread will stay the same for like 100 years, as an example. And in a true bimetallic system, but it could be a gold standard, bimetallic is better, and that can be proven, but it's outside the scope of this discussion. You actually see a general decrease in price. So there's no need for a financial planner in those circumstances. You know that $1 tomorrow is as good as $1 today, or $1 10 years from now is as good as today, or $1 30 years from now is actually going to be worth more. Why? Because people are naturally going to do increased productivity. If there is a way to make a widget faster, better, or more profitable at a lower cost, that it will take place. And you see that, of course, in today's world as well. I mean, you look at what the laptop computer looks like now, which is basically a pad of some type, versus what these things were like going back a decade or so, and what the costs were. So costs come down, efficiency goes up. That's an increase in productivity. And when you have a normal or a sound monetary system, I would consider it normal, although the markets might disagree, you see that. So the money, the sound money, is actually worth more over time, not substantially, but generally speaking. But in a system where all heck breaks loose, where you can print money ad infinitum, then you get huge distortions in the economy, and that's what we've been witnessing now for a very long time, and primarily from the time of August 15th, 1971, when Nixon closed the gold window.
Right. So the illusion of, from what I understand from you saying, really the illusion of fractional reserve banking in this current experiment is starting to wane on the public's view of sound money, precious metals, as they relate to the historical backdrop of what humanity has witnessed throughout all the written history that we have. Is that correct?
Well said, Mike. That's right. If you go in the context of the big picture, unsound money always fails. It always fails, and you always have these large distortions where people wonder what's going on. Why is it costing me more labor to keep the same standard of living, or why am I making more, quote unquote, a larger amount of quote unquote dollars, but my living standard's off, or why can't I afford a brand new, Ford when 10 years ago I could, that type of thing. So people start questioning what's going on, and it's a repeat. I mean, this has gone on throughout history again and again and again, but most people don't study history, so they don't really have a context in which to see that what's really taking place is something that's taken place before. But I need to say that really this is the first time where it's been a global event. Never in the history of what's recorded have we seen a time when it basically affects everybody, and the reason it affects everyone is that the U.S. dollar is the reserve currency of the world. And so as the dollar goes, so goes the world. Not that maybe some competing currency might do a little better, or some country that might be more self-sufficient might do a little better, but believe me, when the ship goes down, it's taking everyone with it.
No, I'm hearing you very loud and clear there. I mean, the central banking cartel coming on the waning end of the fractional reserve banking system, putting together an illusion, basically, that a lot of our listeners, even you can find yourself in some dimensions, are trapped in, because it is having such a great impact on our everyday life. Now, with saying that, you and I have talked off air about what is really impacting the silver market, and I know you had some very strong commitments and thoughts about the Federal Reserve, the threat of tapering, and what impact, in your opinion, is that really having on the precious metals market, especially silver?
The threat of tapering?
Yes.
It has definitely had an effect, in my view. If you go back and you look at the QE announcements, and you go to QE1, the markets reacted somewhat. QE2 is very interesting. After the announcement, silver had broken out at the $19 level, and I do trading as well as investing, and for our advanced members, we had a breakout at 19, got right on it, and rode it all the way up to 26, and I took my position off, and then QE2 was announced. And I let the market dictate, what to do. So as it came back up through 26, I got right back on it. And this is, again, right after the QE2 announcement. Well, silver went from 26 all the way up to 48. And really it got ahead of itself. Not that 48 is the true value of silver. I don't think it is. I think it's higher than that. But it got there so quickly. And there were a lot of people coming into the silver market. I was warning people both privately and publicly that they should consider not buying all that they want in the silver market above 30, 35. If you have to buy it, buy some, I said, but please keep some cash available. And unfortunately, the $48 top, I was able to call that, luckily, or not. I did call it. You can call it luck if you want, and put on some hedges. But I did not keep those hedges on probably as long as I could have, because obviously it would have been smarter to keep those hedges on month after month, really year over year, till now. It's the end of April. It'll be 3 years since that nominal high of $48. But the impact was up on the QE2 announcement. Now QE3, taper, and all this stuff is having not much effect in raising the price of silver, but it seems to definitely have an effect of it coming off. And this is true of the gold market as well. So the idea that the Fed will tighten sends the metal south, whereas the second time they announced that they would, open the monetary spigots, it had a big effect. QE3 basically has no effect moving the price up. So the effect of we're going to tighten the money supply has an effect to bring it down, but the idea that we're going to continue to print print money, the Federal Reserve is printing the money, the U.S. government's borrowing it from the Fed, so it's borrowed into existence, to be clear on that, hasn't really done much. And of course, this is one of the huge questions that we get, that why is this taking place, and we can address that later in the interview.
Okay. Now, you brought up a great point, and that is, in that fractional reserve system where you're creating fiat dollars out of nothing, you mentioned that it didn't have as much of an effect in QE3. Do you think that any of the additional easing measures that the Federal Reserve might deploy are they going to continue to have less and less of an effect on all asset classes, or is that really just more lipstick on the pig as we move forward?
No, great question. Take some time to explain it. So going back to what we just spoke about QE2. So the idea is that, the increase in the money supply is inflation. That's a strict, hard definition from the Austrian school. So we have to say for fact that the inflation has taken place. What we getting into, more importantly, what is taking place and why. So when QE2 was announced, the perception of the market was a lot of this newly created money would be going out in the system and you'd see huge inflation. Silver anticipated that and rose in price dramatically, but didn't take place, meaning that the increase in prices across the board didn't take place. The velocity of money, which is the turnover, the amount of times money goes through the system, was very low. And so all that money printing, which did take place, and that is inflation, basically went as if it was, these billions of dollars were buried in a backyard somewhere, because they only went into the banking system. They did not go out into the general economy. So there wasn't any increase in demand at the general price level, meaning the public. And remember, the U.S. economy is about 70% based on the consumer. It's about buying, knickknacks, doodads, and electronics and everything else, needed or not needed, that keeps the economy going. So the idea of Keynesian economics is that the government will fill in the gap. When the economy is slow, the government will come in and print money to stimulate the economy. And in all fairness, that works for a while. But as I've said in the past, everything has a limit, and the fiat monetary system has always had a limit, and we've reached that limit. The QE2, I think, was the proof of that, because they made the stimulus announcement, the silver and gold markets anticipated it, and it didn't take place. What happened was the money stayed stagnant. It only went to the balance sheet of these too-big-to-fail banks, and they were able to work the spread, the interest rate spread. They borrowed from the Fed at a very low rate, and they loaned it back to the Fed at a higher rate. Well, what a great way to do business. And they get to leverage it on top of that. So instead of getting just a couple point spread, they do it in a leveraged manner, so they're making like 10, 12% on this quote-unquote money. So QE3 comes along because the Fed's getting worried and saying, we're not seeing inflation, and we want to see some inflation. And I think they're being honest about that. And, of course, it doesn't happen because these banks just hold on to the cash again. And now they come back and say, we're going to taper. We're going to take some of that cash away. It says, no, we're addicted to this. We have a lot of mortgages that are worthless on our balance sheet. We've got a lot of other toxic derivative assets that are worthless on our balance sheet. We want to sell that crap to you, Mr. Federal Reserve. Please keep buying it for us. Any threat that they're going to quit buying this toxic crap, it sends the market down, including the precious metals market. So it's a real mess. And there's no real way out of it as far as I see, other than for the market itself to take control.
No, I definitely I hear exactly what you're saying. So so the banks really did more with the funds they received from the discount window. So instead of just, and as I understand the theory, and maybe you can correct me, they were the attempt was to raise their tier 1 capital, and that was by their charter, to make sure that they could stand a certain amount of economic stress, which they completely obviously failed in 2008 with the housing market crash. And in doing so, taking that money down, they put that money obviously back in the stock market, where then you see all that leverage taking place, where it looks, the illusion appears that we have this skyrocketing recovered stock market, but the average person that's participating, we're all participants in the economy, is really a lot worse off now than they have been probably in the last 30 years. Yeah, in fact, I think it's 1976 or 78. I always forget which year, but the idea is what's important. From that time frame till now, in real terms, not inflation nominal terms, where you're making more dollars per year, but in the amount of value or purchasing power that you have from 1976 to now, the average American has gone down.
not up.
Yeah, that's unfortunate, because I think by and large we have a very ingenuitive citizenry that really puts forth a lot of effort, at least the majority of the citizens. Now, let me ask you this: what are some of the events that could actually trigger a run on silver?
Well, there's several. One is, of course, idealistic from my perspective, and that would be, a huge wake-up call where shows like yours, or maybe even a mainstream, which is doubtful, but some type of wake-up event of some type would hit into the mass consciousness of the general population, and then would wake up and say, oh my goodness, I get it. I need to have precious metals. If I don't, then I'm doomed. And actually, I believe that will take place at the top of the market, and it won't be that many people, but it'll be new buyers into the market. And unfortunately, like all markets, like the housing bubble or the tech bubble or any of these bubbles, silver and gold will probably be actually overvalued, believe it or not. It's hard to say that now with them so undervalued. And there'll be people that wake up, but they're waking up really too late, or they're late to the party. So that would be one. Another one would be some type of default scenario. And we've already seen that in the gold market. We've seen where Germany wanted its gold back from the New York Fed, and the New York Fed said, sure, no problem, it's your gold, we'll give it back to you, just give us 7 years to do so. And this is absolutely preposterous, and why, Germany isn't, sending their warships over. I'm being facetious, let me take that back. Why Germany isn't having more of a reaction than they have is a little beyond me, but then on the other hand, I have to say, well, they're all central bankers. I mean, when you go back to what we said just previously, the Federal Reserve is there for the banks. It's not there for the economy. It's not there for monetary policy. It's not there for what their mandate says, really. Basically, the Fed is there to protect the banking system, not the economy at large, regardless of whatever someone says or some newscaster points out. We want to see the job market improve, and we care about your pain and all this other stuff. It's really nonsense. They're there for the banking consortium and nothing else, really. Now, maybe some of these people are speaking directly how they feel, but that's not the hard facts. So another thing that could take the silver market higher, or the gold market higher, is some type of default outside of what we've already seen with Germany. This would be some default on the COMEX, some large hedge funds couldn't get their metal, and a basic squeeze on the market, which we're really seeing right now. Believe it or not, what we're seeing is that China continues to buy physical metal month after month, and they're buying in large quantities, and it is being fulfilled, but it's being fulfilled at a low price, and that can't go on forever. So there'll be a day of reckoning, I think, just from the dynamics of the market. I mean, you can fool some of the people some of the time and all the people some of the time, but you can't fool all the people all the time. The Chinese are not being fooled. They know the dollar's near its end. They don't really want much to do with it. They continue to buy gold. The yuan is the second strongest currency in the world, and they basically backed away, as have other nation states. And this is the end. This is where you know that we're getting close to the final, part of the play. This is the last act, so to speak, as a metaphor. Because when the dollar dies, it doesn't necessarily die overnight, although it can. You could have a bank run or a bank closure and a new currency issued, and that probably could take place. But before that, you're going to see what we've already seen. China says, we don't want to buy any more bonds. We really want to see some other currency system besides the U.S. dollar. And that's backed up by Brazil, Russia, India, South Africa. And it's been tried in the Middle East. You look at Gaddafi, he won the Golden Dinar. He's no longer around. Saddam Hussein, whatever you think of him, regardless of the personality, he basically wanted to go on the euro for oil. Well, look what happened to him. So it's just, and it's a power play. It's a power play. It's about, it's basically, and I wrote about this in the Morning Report. You've got the Anglo-American Empire, which is the London-New York banking consortium. And they basically have ruled the roost for a very long time. But what has happened in the last decade or so, and maybe longer than that, this is my take, but I'm accurate on this part, that the China, Russia, Eastern Alliance, the Asian market in general, has said, no. You're not going to be the king anymore. We are. And so it's not like all these central bankers love each other and they're all getting along. They all have they're all megalomaniacs and control freaks, and they all want to be the top dog. But it's not like they're all in agreement of who that top dog should be. So you're seeing a discrepancy between the Anglo-American Empire that's kind of dying off and the Eastern Empire that's growing stronger. And that will continue, and this thing probably will not go well, because what normally takes place is, unfortunately, what we're witnessing. Oh, well, we're not getting our way, we have a big tantrum, let's start a war somewhere.
No, that was very well said. I mean, you're absolutely right coining the term in the last act. I mean, if the general public, and that was one of your first triggers, were to wake up to the fact that all of the first world economies were monetizing their own debt, meaning basically creating it out of thin air and then borrowing it back from themselves in some kind of quasi-Ponzi scheme, I think you would see that curtain close really quick. And that is where the default scenario is a true statistical probability, and then you ultimately have, unfortunately, world war. All as a result of the fact that we did not stay educated about sound money principles. And I know that in the Morgan report, which is a famous report, not only because you can historically go back and look at the timing success that you've had, calling the markets, it's just been phenomenal. Brad and I are very intuitive to looking at how much effort that your team has been putting into making sure that you're using realistic events that are going to drive your decision-making process. Now, I know that because you have been so successful here, you just returned from speaking in Europe about precious metals. Can you tell our listeners what you spoke about while you were there?
Yes, I spoke at where are we in the metals markets, and what I said was I think the bottom is in for the silver market. I'm not so sure about gold, and of course I admit I could be wrong, but right now I showed several charts, which I do some technical work. My letter, by the way, is not that technical. I've like 3 levels of service. The basic services is a written report you get off the internet and you can print it out. The next level is that report plus some charts, because it's for people that are interested in that kind of thing, what kind of trades I'm doing, and of course you have to use charts for that. But during this lecture, I showed where I think the bottom is in. It was on the 28th of June of this year. Silver hit 1817 during the trading day. It moved up rapidly and closed about 2007, so it was almost a $2 move in one day. It was far lower than the day before and far higher than the day before, and it's called a Q reversal. And a Q reversal is called Q reversal for a reason. They happen very rarely, and usually they signal something important. In the Japanese candlestick methodology, it's an engulfing something or other. I forget the real name. But so that took place, and so what you need to do is, well, Mr. Smarty Pants, if you're right, then the market has to prove you right. And so from that point till now, we have built a base higher than that level. It doesn't mean that I'm correct yet. What it does mean is we've had, 5 months of data, or 5 months of the market, manipulated or not, and of course I believe it is manipulated, but regardless, the price has been higher than an 1817 level. So I think silver has probably made that intraday low for this long-term bull market, where we've seen it go to 48 all the way down to the 18 number I just mentioned, and back up now into the 20s. And it will work its way higher. I think this month is the worst month for the metals in this whole entire process, meaning the last couple of years, or almost 3 for silver. And then we're going to come out in 2014. And it could go up, fairly strongly. I don't expect anything monumental, although it could, I wouldn't rule it out. I think we're going to see, strengthening in the market. I think you're going to see both gold and silver get through their, what I call the breakdown points. And if you follow my work, that was $26 in silver and about $15.50 in gold. And once we get above those levels in both the metals, then we will have more participants come back into the market, whether they know it technically or just intuitively. It doesn't really matter. The market never cares if you're a technician or not, either buying or selling. So you'll see, I think, strength again in the metals. So I'm looking for a good year in 2014, but not an exceptional year, with the caveat that there's so many black swans, and we are in the last act. And if we get a non sequitur of some type, or something comes out of left field, that no one's prepared for ahead of time. Because my readers are, I would hope, but regardless, unless that happens, then I would accept pretty much normal market activity. But again, something could take place. That's why I emphasize you really want to be 6 months or 6 years too early rather than 6 minutes too late, because these markets go where I believe they will be going at some point. You might not be able to get the metal, or you might get delayed delivery, or you might not get through on the phone. I mean, as odd as that sounds, that's fully what I expect this time, because these precious metals are called precious for a reason.
Right.
There aren't many of them, and there aren't many places you can buy them, believe it or not.
Now, the European, when you deliver that message to your audience in Europe, now they approach precious metal holdings differently. And when they hear the things that you're saying, have you looked at their motivations in terms of how they treat the forecast and the research and what they do in actually acquiring? And again, for all the listeners, acquiring precious metals could be something that you do in a very limited sense. It could be something that you do as an overall strategic part of your portfolio. It really depends on where you are economically. But silver, thank goodness, no matter where you are economically, there's always a way for you to go out and acquire a little bit to safeguard your family and your finances. And that's the beautiful thing about that particular precious metal. And that is really why we're so interested in understanding David, his Morgan report. But to circle back around, can you tell us a little bit about that European draw and why your lectures are in such high demand there?
Certainly, and I might have been a little misleading, but I'll correct it right now. My normal European trips in the past have been like London, Paris, Geneva, Zurich, Munich. So I've hit, France, England, Switzerland, and Germany, and maybe a couple cities in a few of those places. This one was just to Munich. It was only the Germans. And so let me be very specific here. The London crowd, I think some of the hedge fund guys definitely get it. The general population, I'd say no. But the Germans, without a doubt, get it from bottom to top, from the top, money manager to the guy on the street. And the reason for that, in my view, is because, they have parents or grandparents that went through the Weimar Republic, and they realize that fiat currencies can be destroyed. And one of the most interesting things was I've done that show, I think, 4 times now, is the amount of physical metal that's at that show and the amount of physical buying that takes place. And one thing that probably most of the listeners don't know is that there's a VAT in Germany and most of Europe. It's a value-added tax. And they pay like 17% on top of the spot price, which is marked up. In other words, just like any dealer that you have in any country, if the spot price of silver is $20, for example, and they sell it for $20, they're not going to make a living. They're not going to be able to feed their kids or buy shoes. So they mark it up just like a stock or anything else that's in the investment field, and you pay a little higher price, and that's because of the minting, transportation. The guy's got to make a living. So usually you're looking at 4%, 5%, 6, 7. It depends, but there's a percentage. So a dealer in Germany's got his markup, which we'll call it 4% for talking purposes, and on top of that number, you have a 70% value-added tax. And you know what? It doesn't stop them. Now, that VAT is going to be up to 19% starting in 2014. So it might have been a little bit more of a mad rush, so to speak, than what I'm used to, because a lot of Germans were probably saying, well, I'm going to save that 2% now and buy, and of course the metals are low, etc. But there's, in my view, and again, I've traveled Europe now and done these speaking tours over there like 3-4 times. The Swiss get it pretty well. They're pretty quiet. They don't make much noise. But the Germans, again, top to bottom, they get it. And why? Because they've lived through it. They've seen it, not them, that generation, but someone in their family's history has. And so they're very, very aware that these government promises, or the monetary system is probably a better way to say it, is not stable when it's not backed.
Right. Now, we've spoken, and you know that we agree that your individual finances are always your own responsibility. Now, Brad and I have been using the Morgan Report to time our purchases of physical silver. Can you give a brief overview of not only what the layman can expect in purchasing small or medium amounts of physical silver, but also what your higher tier investors can look forward to in seeing in your report, and how they can benefit by getting involved in your research and the due diligence you do on the various mining companies and the bullion depositories?
Sure. Actually, there's a YouTube video that I did recently that I actually went in and moved the cursor around inside the members only part of the website. So you might check that out on YouTube.
And where would they find that? Can we?
I forget the name, Mike. I forget the title of it, but it's recent. It's in the last three weeks or so. So basically, what you get is my editorial, and then our team works on different aspects of the market, and we take questions from our readers. Really, we still think that you can get leverage once you've bought physical metal and hold it in a safe place. That then, if you want to increase your risk to reward ratio, you go into the underlying mining shares. And some of these mining shares are like never expire call options. But I look at three tiers: top tier, mid tier, and speculations. And speculations, what I teach is money you can afford to lose. A speculation is a speculation is a speculation. And these things are very, very difficult to anticipate how well they'll do or not do. And therefore, you really should reach out and try to buy like 5 or 10. We have no more than 10. I hate long lists. Anyone could put 100 different little companies on their list, and 2 or 3 of them hit it, and brag about how good you are. But when you have a small list, you've really got to pay attention, and that's what we do. Plus, we really can follow 100 companies. I'm not trying to put down my peer group, and I know almost everybody in the gold silver newsletter business, but so that's what we do. And then on the next level up, I show you what I'm seeing in the markets, and we'll go through some of the charts, talk about the bond market, the U.S. dollar, the general equity market, the metals, of course. Sometimes I'll go off and look at like the Baltic Dry Index. I've been asked by my readers, and I really have been a little remiss on this, to look at specific stocks. How is a certain stock holding up technically, or which one's stronger than another, or that type of thing. So we really do work for you. I mean, we work for our members, and so that's it. And then on the top tier service, that's really for high net worth individuals or fund managers. And that's basically a consulting service where I go in and answer their questions on an individual basis, that type of thing. Or if there's a special situation, basically it's member driven by people that are on that level of membership.
I think that there's something to benefit having gone through the report and the information available. I think there is something available for everyone in any tier. And that goes from someone who only has, $100 to put money away in precious metals, to someone who's looking to move around, tens of thousands of dollars. I think there's something for everyone to benefit there. Now, having said that, you spoke about the gold and silver ratio. Now, I know we have had other guests on speaking about precious metals. I want to get your take on that ratio as you see it affecting the prices of silver, and exactly what is that by your definition?
Well, the gold-silver ratio is pretty simple to understand. It's basically how many ounces of silver does it take to buy 1 ounce of gold. So right now it's about 64, so it takes 64 ounces of silver to buy 1 ounce of gold. That's the gold-silver ratio. Now, when the market was in its infancy, in this bull market, it took 80 ounces of silver to buy 1 ounce of gold, so the ratio was 80 to 1. And now it's 64 to 1. So obviously silver has outperformed gold if you put the starting line at the start of the silver bull market, which I put at September 2003. Now, you can play games, and everybody does, and maybe I'm playing one. I'm not trying to. I'm trying to be very objective here. I called the bottom at that time, and that's on record. That's in the public domain, and that's when the ratio is 80 to 1. But during that time, we've seen silver go as low as 35 to 1. And if you play the ratio, in other words, you trade silver to gold and gold to silver, depending on the ratio, you can actually end up with a lot more metal. But it's tricky, it's difficult, it's not easy, but it can be done.
So that would be an advanced technique, basically, is watching that and using that as a large, weighted decision, using that in a decision-making process and putting a lot of weight on that particular ratio. Has some ups and downs, but they could go either way, is what you're saying.
Yeah, that would be something I'd do on the advanced service. I'd put out the chart and say, look, here's, where the ratio's been. I think it might be a good time to take some. I'm very cautious because I always want to be right. I don't want to make mistakes because, we're dealing with people's lives here. I mean, this is not something that is, not to take seriously. And, you could swap some silver for gold here, or you could swap it the other way, that type of thing. But, so what I expect is that since the ratio has been as high as 65 to 1, and it's now 64, so it's creeping back up, but I still think 65 will hold, which implies that silver has hit its bottom. So when the ratio is getting less, the number's lower, what that means is that silver is outperforming gold. And usually as the ratio declines, so as it goes from 65 down to 60, which is also done recently, now it's moving back up, that is an indicator that you have reached a turning point in the market as a whole. So the ratio can be used not only to determine which metal is performing better than the other one, but it also can be used to determine swapping or trading. And lastly, it can be used as a market timing indicator to find out if you have reached a turning point in the market. Now, I'm sticking my neck out here because, 64 to 65 is not much of a difference. But I think that we probably, again, have probably seen the bottom in the silver market and maybe not in the gold market. So for me, you could see the ratio get, say, double test the 65 level and then start coming down 64, 62, 62, down to 60 and lower. And that would be another indicator that, silver has seen the worst it's going to see during this washout correction that we've seen from the top in the very, very end of April 2011.
Yeah, it's good timing. Now, I've heard you mention Archie's rule. What is Archie's rule?
Archie's rule is a way to determine objectively whether or not a mining company should be really go into business, or if it is in business, if it's going to remain profitable or not. So a lot of people just kind of willy-nilly buy into the mining sector by, the three-letter designator is the same as my child's, abbreviation of their names. We could do my daughter, Katie, it could be KEM, and KEM is a symbol that's like this symbol on this mining stock, therefore I'm going to buy a bunch of it. I mean, people do really irrational things. Where Archie's rule says, what does it cost that company to get an ounce of gold out of the ground, or an ounce of silver, or an ounce of, or a pound of tin, or whatever? And what is the margins of that company? And what are the prospects of that commodity going from that price to a different price? So it's basically a way to look at a market through a very objective lens that the prices are not always going to remain high. They're not always going to remain low, but it gives a view of if silver were to go from 48 to 20, would this be a good investment or wouldn't it? So it's a way to determine if you should buy a mining company or not. It really is. And it's something that very few people use, but we did a special report. I interviewed Dr. Peter McGaugh, who is, in my view, probably the premier expert on silver in Mexico. He's probably traveled almost every inch of Mexico. I'm exaggerating slightly, but he's been all over the place. And he was the one that brought it to my attention at one of the mining shows years ago. And I asked him if I could do an interview for my members about Archie's rule. And it's a very good way. Now, the problem with it, if you want to call it a problem, is that it applies to producers or near producers. You couldn't use it really on an exploration company very accurately. You could if there were a lot of facts known about an exploration company, that they have this much in the ground, and their proposal with their economic analysis shows, how much they're going to invest and what's going to, their capex is going to be, that kind of thing, what capital expenditures are going to make, and how much it's going to cost to build the mill. So you get a feel for it. But it's a very good way, and again, I don't think people realize the value of it. But if you want to buy a mining company, or you want to buy a stock in general, I'll be very general here. I mean, most people buy something cheap. They don't buy the best. And this just infuriates me, because if you look at the general public and the way most people conduct their lives, if they're going to go and buy a house, they're going to buy the best house they can afford, or they're going to buy the best car they can afford. It might not be a new car, but it'd be a used car, but they're going to buy the best. They're not going to buy one that's going to require a bunch more money to get it on the road, for an automobile example. But when it comes to the stock market, all that logic goes out the window. And they buy something that's cheap, because if I buy this stock for 8 cents, look at all these shares I get. So what? They're cheap for a reason. Most of the top-tier companies that we feature are companies that certainly have come off in price, but they've kept your wealth pretty much intact. Whereas a lot of the guys in our industry just dink around, and I use the word dink around, with these junior miners that, for all practical purposes, most of them are out of business. And the ones that aren't, many more probably will be. So if your portfolio was made up of a bunch of these little dinky stocks, I'll call them, and I hate to lump them all together because there are some values out there, but nonetheless, cheap stocks, again, are cheap for a reason. So these things are kind of off the board. Some of the guys are pretty much out of business. My business is certainly off, but I've done what, I teach what I do. Big money, serious money goes into a serious company. Mid-tier money goes into mid-tier companies, and speculations are money you can afford to lose. And I've had probably more speculations that have become mine than anybody else in the industry. Now, can I continue that? Probably not. It was a lot easier going back more than a decade because there weren't that many to choose from, and the guys that were holding on to these properties were people that were, eating beans every day and, sold their 3-bedroom house for a 1-bedroom shack because they knew their properties were so darn valuable. So it was a little easier for me at that point in time than it is now. But the point I want to make is this. Starting on some of those companies as speculations that became viable companies, like Western Copper would be a good example, we bought more as it moved up. Why? Because it's a different animal. It's not just a property that hasn't been explored. It's been drilled. We know what we have, and some people don't understand drill results. And of course, it was a hotter market too, and that had a lot to do with it looking backwards. But nonetheless, that stock went, ballistic. And we had a few like that in the speculative section, but it's, again, getting more difficult. And, whether or not any of them in the speculative section will become, producing mines in the future or not, I really don't know. Obviously, that's what we shoot for. We do our best, but nonetheless. So the idea is that you can get a good one and don't be afraid to pay more. I mean, it's a fact that as these companies develop, you can develop your strategy to go along with it.
Now, you mentioned something in that dissertation, which is very much appreciated, because I think to make sure that our listeners know, and the people that are interested at any level in acquiring precious metals, dealing with the Morgan Report and you personally, and how you are just in every facet of this genre, it is so important to the actual outcome and the success of how from a small investor to a medium to a large investor is timing their entrance and exit into the market of precious metals. Now, you said keeping your wealth intact. That was a very, very strong point you made. And we do see that people are they will buy the best car that they can afford. They'll buy the best jacket they can afford. They'll buy the best house that they can afford. And we also see, this time of year is a time that we're celebrating our loved ones and our friends and family. Brad and I had discussed just the other night that part of keeping your wealth intact is that's really about making sure that your family members, if you're going to extend a gift or an offering, that gift or offering comes in the terms of precious metals. That is wealth that will last generations if held on to. And God forbid you ever have to use it, but it is there, and it's going to weather the test of time versus some of these other gifts that can be given, whether technology or it's going to be outdated in 6 months from now. To get people to understand that they have all of your subscribers, all of our viewers work so hard for their money. They really pour themselves in, and they're limited to their vacation time that they can experience every year. They're limited to the type of house that they could buy, but to make sure that they are putting a certain amount of money, and I'm saying that could be $100, it could be $50, it could be $10,000 or $100,000, to making sure that you're paying attention of your wealth and how you're going to pass it on and how you can safeguard it for the rest of your life. I think that's very important. Where can our listeners find you on the internet? I know you have you're a supporter of the News in 2 Minutes, which is just, I can't thank you enough. It's such an important project for us to continue to supply hard-hitting current event trend news to the public. How can they find you if if the listeners have not seen your commercial there?
Well, probably the easiest way, if you forget anything else, is just type in David Morgan Silver into Google or a good search engine, and you'll pull up a lot of stuff. But for free and for fun, I do the YouTube, which is Silver Guru, is a channel for YouTube. For Twitter, I'm at SilverGuru22, and that's a good feed. I usually, my guys, my team and myself, put up news articles and interviews like this on a Twitter feed. I'm not interested in letting you know if I'm having a latte or what I'm eating.
Right.
I don't do any of that nonsense. But I do put up articles that are of merit to anybody that's just generally checking the overall economic picture. And then we also, of course, cover the metals as well. So there's usually 4 or 5 things. And if you just pay attention to that Twitter feed, you're going to get kind of I only put them up there after I've read them, and I think they're of merit. So that's a way to kind of stay tuned up to the news on a daily basis. Of course, there's nothing that can compete with 2-minute news, you guys. I don't know how you can do that all in 2 minutes. I've watched it every day now since I learned about your channel.
Well, thank you. Thank you.
And then, excuse me for interrupting, the paid website is silver-investor.com. So there's YouTube, Twitter, and the paid website, or it's free. There's a free letter on there, too. It's silver-investor.com. You can get the free weekly e-letter, and then the paid service is 3 levels of membership.
Oh, that's great. Now, David, it was a personal honor to have you on the interview and to have you on the show. We ask you to stay safe, and we are all going to eagerly await your next report. I will include, for the listeners, the links to David's website and his videos in the description box below this video. To all of our listeners and to you, David, as well, we thank you for joining us and have a safe week. Good night.
Thanks so much.